Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. Finally, some proper movement. A second bullish white soldier on Friday and a more than adequate follow-on higher to the previous session's superb combined key reversal up, bullish engulfing pattern, and bullish long white Mariposa. The action once again highlighted the two core patterns here. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a September to date ascending triangle, currently at 98.31 to 99.55, and a September to date ascending wedge pattern, currently 98.31 to 101.62. Recently, both patterns had false breaks in both directions, which complicated things and compromises both patterns. However, both patterns have also repaired themselves, and Friday saw a clear break above the upper trend line of the ascending wedge pattern to complement the earlier clean break above the ascending triangle. What was interesting about Friday's action was firstly how it was based on the combination of the upper trend line of the ascending wedge pattern and the November 2002 high at 101.70. And secondly, how it broke up through and closed over the April to date downtrend, currently at 102.50. Finishing up closing just over the January 2017 low at 103.38 and right on the December 2016 low at 103.49. There is further congestion nearby overhead at 103.69, and overall above this we have the declining long moving average. Don't forget that one. Currently at 104.23, entering the frame from above. So if all this action, we must now look topside and see what are the opportunities for these patterns. I'd previously listed possible targets for the ascending triangle of a primary target X in the 102.65 area and a secondary harder to reach target X1 in the 103.65 area. And for the ascending wedge pattern, a primary target X2 in the 105.35 area and a secondary harder to reach target X3 in the 107.65 area. Well, the primary target X for the ascending triangle was reached on Friday, and the harder to reach secondary target was missed by just one tick. However, it was reached today. The only thing left to discuss is the January to May 2021 bearish Andrews pitchfork. This pitchfork had previously been broken on the downside as recently as October. The question now is whether the market will still find utility in the upper times for this one. At the moment, the market is in between the middle time below, currently 101.42, and the upper time, currently 105.13. So far today, a gapping higher open, since filled in, that reached up to the next target level X1 at 103.65. However, since then the market has pulled back lower, capped by the congestion at 103.69 and below both the December 2016 and January 2017 lows, and looking like day 2 in a 2-day tweezer top pattern right now. Cable, aka sterling against US dollar. A second bullish white soldier on Friday. This was a second consecutive close over the upper flat trend line, currently 115.05, as well as the declining medium moving average, currently 116.49, of the recent ascending triangle, and a first close over the upper trend line, currently 117.68, of the recent ascending wedge pattern. To recap my earlier comments, much as in Eurodollar, there are two core patterns here. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a late September to date ascending triangle, currently 113.62 to 115.05, and also September to date ascending wedge pattern, currently 113.62 to 117.68. Both patterns had previously been compromised, and both have repaired themselves. Late last week, there was a break higher over the flat trend line of the ascending triangle, giving possible targets of target X in the 120.20 area and a secondary harder to reach target X1 in the 122.50 area. We've only had the one close over the ascending wedge pattern as yet, but I'll keep a close eye on this week. In the end, prices have been held down by the lesser Fibonacci line at 118.59. Interesting, we don't have that much resistance topside past this lesser Fibonacci line until the May 2020 low at 120.73. So far today, a lower open with a dip below the upper trend line of the ascending wedge pattern, but seemingly not straying too far away from there. Right now, today is looking like an indecisive spinning top, possibly. That is also a bearish harami, and maybe actually moving more towards a bearish harami. Euro sterling. An immediate countering bullish harami on Friday, if only just. This comes after the previous session's reactionary bearish engulfing pattern. Though the market had previously halted ahead of testing the 50% Fibonacci line of the March 2020 to March 22 move at 88.51. The move lower was conversely also well supported at, surprisingly, the lesser Fibonacci line at 86.98, which is just below the April 2021 high at 87.19, as well as the rising short-medium moving average currently 87.21. I suspect the halt in the decline and perhaps the main support may have in part been due to the short-medium moving average and April 2021 high combination, but more due to the breach but since repaired lower time, currently at 86.82 of the bullish April to August Andrews pitchfork. Now, so far today, a slightly higher open and an exploration of the upper side just short of last Friday's high right now, though seemingly without much enthusiasm and looking like an indecisive spinning top or doji cross right now. US dollar against the Indian rupee. An inverted hammer pattern on Friday, which is an interesting follow-on lower to the previous session's big combination of a key reversal down, a bearish engulfing pattern, and a bearish closing long black Mariposa, which to be honest is a bit of an overkill given the earlier session was just an indecisive doji cross. Nevertheless, the market gapped open lower, which was since filled in, and went down to most emphatically test the rising medium moving average, currently 80.48, and in the end not managed to break below it. Now, inverted hammers are interesting patterns. Traditionally are seen as a bullish reversal pattern. However, the data indicates that approximately 6 to 7 times out of 10, they act as a bearish continuation pattern. Thus, it'll be interesting to see if the market will follow the tradition or the data. I now need to discuss the larger scenario which I had previously mentioned in my commentaries. So, I highlighted how we have a September to early November ascending expanding wedge pattern. Late 2 weeks ago, prices had pushed down through the lower trend line, currently 83.30, and a move lower since then has confirmed the pattern. Hence, we had a primary target X in the 80.90 zone and a secondary harder to reach target X1 in the 80.28 zone. Last Thursday, the market reached the primary target. We've since seen the market being shy of testing the rising medium moving average below, currently 80.48. Beyond this, we have a gap below dating from September between 80.06 and 80.18, which is significant. And then the August to date uptrend currently at 79.91. I should mention that this uptrend is part of a July to September ascending triangle pattern, which was successful, but which has its upper trend line currently at 80.02 in there as well. So far today, a reactionary move back up with what looks right now like a bullish opening along white Mariposa. At the moment, prices are being capped by the rising short-medium moving average. That is just above the recent 50% Fibonacci line at 81.13. US dollar against the Brazilian real. A very large, yet still indecisive spinning top on Friday that could also be seen as a bearish harami, if only just. All this followed on from the previous session's huge bullish opening long white Mariposa, which in turn was a more than adequate follow-on to the earlier bullish engulfing pattern. Friday's action pointed out one clear feature. The overhead breached upper time, currently at 537.11, of the July to late August bearish shift pitchfork still has a significant influence in capping the market, especially on a closing basis. Interestingly, the 50% Fibonacci line below of the May 2020 to April 2022 move at 527.37 does not look that good as support now, though the other 50% Fibonacci line below at 522.76 of the March 2021 to April 2022 move does look a better support. I suspect this may be due to the conglomeration of moving averages nearby, specifically the short moving average, currently 522.67, short medium moving average, currently 523.01, and the medium moving average, currently 524.10. Additionally, I'm still mindful of how the market almost set up for a possible monthly key reversal last week. I will still keep this in mind. US dollar against the Mexican peso. An immediate countering bullish harami on Friday, if only just. This coming after the previous session's very large bearish engulfing pattern. It was nevertheless the lowest low since early March 2020. This current move lower all relates to the previously highlighted crossover combination of the broken upper time, currently at 1962.84, of the March to July bearish Andrews pitchfork, and the middle time, currently at 1976.34, of the still intact bearish shift pitchfork for the same move. The latest casualty had been the May 2022 low at 1940.70, which was support, became resistance, and is now support again. Prices rose to pierce the 2021 low at 1953.63, but closed just below it. So far today, well, a higher open and a fresh move over the 2021 low, but seemingly not that far, as prices held around the 2021 low, looking like an indecisive spinning top right now. The broken upper time is the next resistance above. Thank you for listening. This short version broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.